Hello, everyone. Thanks for joining us today. I'm Brian Cezanne. I'm here today with a group of very talented folks from our national tax practice. We're ready to have a conversation with you about the OBBBA. Um, I'm sure, as all of you know, this month marked a major turning point in federal tax policy. On July 4th, President Trump signed what we are now referring to as the OBBBA. It was a sweeping tax reconciliation bill that really locks in many of the TCJA provisions that were set to expire at the end of this year. It's one of the most significant pieces of tax legislation we've seen since the TCJA itself back in 2017. It passed just narrowly after months of back and forth between the House and the Senate. There are over 100 different tax provisions in this legislation. We've summarized each of them in an ebook that's available to you on our website to review. But today's session is really about highlighting what we believe to be the most important and impactful provisions to our clients, including helping you understand what's in the final version of the bill. So what got made permanent, what got scaled back, and what new ideas made it in during the last few weeks of negotiations. So for business owners and high net worth individuals in particular, there's really a lot to pay attention to. It's not just the headline items like lower individual rates or the full expensing rules, but also some of the more technical provisions around international provisions, GILTI, FDII, the SALT, and deductibility of pass-through entity taxes, clean energy, all sorts of things. And I would also add that the bill really provides clarity on a lot of fronts around rates and deductions, but it also reopens, I think, a few big planning questions. We're going to talk more with Nicole Chiarella and Michael Mishik about some of those concerns. So, for example, we're seeing really early signs that entity choice is back in play. We've got, on the one hand, Section 199 Cap A, the pass-through deduction that is here to stay. On the other hand, we've also got expanded Section 1202 stock exclusions, and that makes really C corporations much more attractive when it comes to certain kind of exits. In the SALT cap area, we've got certainly the increase and the PTET elections that many states still allow. But the right answer really between a pass-through entity or a C corporation really depends on your facts. So that's something we want to pay close attention to and emphasize during today's presentation. So that's what today is really about, is walking through the bill, surfacing some of the bigger picture strategy questions, and giving you enough detail to go back and have those planning conversations with us. Next slide, please. So we've broken out the next 90 minutes into the following segments. We're going to start off with federal, followed by credits and incentives, talk a little about the international provisions, trusts and estates, some procedure and controversy provisions, talk about the SALT and how it's interacting with the federal provisions that we saw in this bill, as well as closing out with some not-for-profit and charitable contribution questions. We do encourage you to submit questions using the Q&A feature at the bottom of your Zoom screen. While we won't be responding to questions in real time during the presentation, we are collecting them as they come in. If time allows, we'll address a few at the end, and then we'll follow up this session with your registration information and get in contact with you and continue the conversation. So with that, I will turn it over to Michael Mishik, who's going to kick things off with our key federal provisions.
Thanks, Brian. Could you move the slides up one, please? So yeah, a lot to talk about in federal, so we'll just get into it. Next slide. First item is that excess business losses. The good news here is that the excess business loss provisions were made permanent with just one sort of minor change. The background is kind of interesting, though. The Senate version really doesn't change much, like I said, from what was originally enacted as part of Tax Cuts and Jobs Act. The House version would have, I think, significantly changed the way that excess business losses were created, were treated in subsequent years. The House bill would have treated the excess business loss carryovers to the following year as effectively additional business expenses in the year, so perpetuating essentially their treatment as excess business losses, which of course limits their deductibility against non-business income. But in the final version that was passed, excess business losses that are carried over future years are still treated as NOLs, which is a more favorable treatment of those excess business loss provisions. The inflation adjusted cap resets though based upon for next year based upon 2024 CPI. This year the cap is still 313 or 626,000 depending upon your filing status. Next year it drops back down to 500,000 inflation adjusted based upon the 2024 Consumer Price Index. Next slide, please. More good news for business. The changes to 163J brings back the DA. So now you get to compute your adjusted taxable income for purposes of determining your 30% limitation by adding back depreciation and amortization. So you get to add back stuff like bonus depreciation, and we also think the expensing of any unamortized R&D expenditures, thanks to changes related to Section 174 that my colleague Bob Alpert is going to be speaking about in a couple of minutes. The trade-off, though, is that if you're capitalizing interest, that capitalized interest gets pulled back into the computation of interest that's potentially subject to the 30% EBITDA limitation on deductibility. There's specific exclusions for straddle interest and interest that's capitalized under the UNICAP rules. That doesn't get pulled back, but if you are electively capitalizing interest into the basis of assets like under Section 266, that capitalized interest gets added back to the interest that is potentially subject to the limitation. There's an ordering rule in the statute that your deduction is allowed for your capitalized interest first, and then any other deductible interest comes next. So a brief example at the bottom here is that in 2026, you've got a taxpayer that's got 300,000 of adjusted taxable income, zero interest income, $100,000 in deductible interest, and 500,000 of interest that's capitalized under Section 266. So the 163J cap is 30% of that 30,000. I'm sorry, of that 3 million. And the total interest expense here is 1.5 million, not 1 million. So it includes both the deductible interest and the 500,000 in capital interest. So on the example, only 600,000 of the total interest expense would be non-deductible in 2026. Next slide, please. Qualified production property, adding a new category of property that's eligible for 100% expensing in Section 168N, so-called qualified production property. It's basically newly constructed U.S. non-residential real estate used as an integral part of a so-called qualified production activity. So something like a factory on which the construction begins between January 20th, 2025 and December 31st, 2029, and is placed in service before the end of 2030. The emphasis in this provision is on newly constructed property, but there are limited exceptions for purchases of certain existing property that isn't used in a qualified production activity or by the taxpayers using it during a specified window period. Another big takeaway here is that the qualified production property doesn't apply to leased property. So you have to be using the property in a qualified production activity directly in order to get the benefits of 100% expensing. The definition of qualified production activity is basically manufacturing, production, or refining of tangible personal property, and those activities must result in a substantial transformation of the property. So you have to be making stuff. And for purposes of determining whether you've got a substantial transformation, likely we'll look to existing authority under the CFC Subpart F rules to determine substantial transformation. There's a lot of authority under those provisions as to what constitutes substantial transformation. But it seems pretty clear that just final assembly of a product may be insufficient to satisfy the standard. So I think there's going to be a distinction here between taking component parts and just assembling them into the final product versus actually making those component parts. The former case where you're just assembling it probably won't qualify. The latter case where you're actually fabricating or making the component parts likely would qualify. Another important limitation on the benefits of this provision are there's a clawback of the deduction if the property is used in a non-qualifying activity during a 10-year look-back period. And the clawback amount gets added to your basis for future depreciation. So if you pull a property out of a qualifying activity within the 10 years, you must recognize the originally expensed amount as ordinary income, but you get full basis credit for that income that's recognized, and you get to depreciate that going forward. Next slide. Sort of related to the prior one is a restoring of bonus depreciation under Section 168K for qualifying property that's acquired after January 19th, 2025, but property subject to a binding contract for acquisition entered into before January 2025 remains subject to prior law. So there's this funky little window period that certain taxpayers are going to have to watch out for. There's a transition rule for property that's placed in service during the first taxable year ending after January 19th, 2025. For that type of property, taxpayers can elect lower bonus percentages of either 60% for aircraft and certain property with longer production periods, or 40% for other qualifying property. So an example at the bottom here shows a calendar year taxpayer that purchased 5 years maker's property, which is qualifying property, in April of 2025 for $800,000. The taxpayer can either claim $800,000 bonus in 2025 or elect to claim only $320,000 bonus in 2025 and depreciate the remaining basis over the property's 5-year recovery period. And with that, I'm going to turn it over to my colleague, Nicole Chiarello.
Thanks, Michael. Next slide, please. All right, so I've got some good news for individuals, I think, coming your way now. So the most significant change to Section 199A for the QBI deduction is that it permanently extends the 20% deduction for qualified business income for pass-through entities, removing that sunset that was previously scheduled for the end of 2025. And the 199A deduction is limited based on wages paid and the basis of property held with respect to the qualified trade or business. So former 199A-B3 turned off this limitation when income was below a specified amount. And the new law expands the taxpayers who are not subject to the wage and base limitation by increasing the specified phase-in income limit from $50,000 to $75,000 for single filers and from $100,000 to $150,000 for joint filers, now with inflation adjustments starting after 2026. It also introduces a new $400 minimum deduction index for inflation as well for taxpayers who report at least $1,000 in QBI from active businesses, and that's regardless of calculated deduction amounts. Next slide. So one of my personal favorites, there were 3 key changes to QSBS eligibility rules under the OBBBA. One was reduced holding period for partial exclusions. Another was increased per issuer gain exclusion cap. Another was expanded qualified small business asset threshold. So QSBS gain exclusion applies to eligible shareholders and provides for an exclusion of gain in an amount equal to the greater of 15 million or 10 times the shareholders' adjusted basis in the stock. Pre-OBBBA, that cap was 10 million, and it has now been raised to 15 million for stock issued after July 4th, 2025. One of the requirements of QSBS eligibility is that the aggregate gross asset value at the time of the issuance of the stock to the shareholder cannot exceed a certain amount. So previously that amount was 50 million, and under the new law has now been increased to 75 million. So the gross asset value cap limitation is tested and applied at all times prior to and immediately after the issuance of QSBS. The other change to that asset value cap is that it's no longer static, and it will be increased annually by an inflation adjustment. And what's awesome about that is it will now allow businesses that are of greater value in future years to continue to issue QSBS. And that is also effective for stock issued after July 4th, 2025. And then finally, the shortened holding period, which provides for a phase-in on that gain exclusion of first 50% for shares acquired after the effective date of the OBBA, but held less than 4 years after their issuance. 75% of capital gain recognized when QSBS is shares are disposed of at least 4 years, but less than 5 years after issuance. And then QSBS held for at least 5 years is eligible for that 100% exclusion of the capital gain up to the relevant cap. So an example of this would be pre-OBBA, if an eligible shareholder held their QSBS for 5 years and they had realized gain of $12 million, 10 million would be that cap that's excludable, and they would recognize 2 million of gain. Now, post-OBBA, if the eligible shareholder holds that QSBS for 5 years and they realize gain of 12 million, all of that gain would be excludable because we've got a new $15 million cap. If they held it for 4 years, 75% would be excludable, and they would recognize 3 million of gain. And if they held it for 3 years, only 50% would be excludable, and they would recognize 6 million of gain. And then it is worth noting that when a taxpayer excludes only that 50% or 75%, the remaining taxable gain of 50% or 25% is taxed at 28%. So not your usual 20% long-term capital gains tax. And this is because 1202A3 specifically says the portion of gain not excluded shall be taxed at a rate not greater than 28%. Okay, next slide, please. Thank you. So here are the key changes under the OBBA affecting charitable contributions for itemizing individuals. So starting in the tax year 2026, itemizing taxpayers can only deduct a portion of their charitable contributions that exceed 0.5% of the taxpayer's contribution base or their pre-NOL adjusted gross income. So any portion below this threshold is disallowed, but it may be carried forward for up to 5 years. That existing limit allowing deductions for cash contributions to public charities up to 60% of AGI has been made permanent. So that already existed, and now it's made permanent, reversing its previously scheduled expiration. And then again, not specific to itemizers, but worth noting that starting in 2026, their non-itemizers can claim a universal charitable deduction for up to $1,000 for individuals and $2,000 for married couples. And then under the OBBBA, the corporations face really 2 new key changes regarding charitable contribution deductions. One is previously, those corporations were generally permitted to deduct all charitable contributions up to 10% of taxable income, and any contributions in excess of that limitation could be carried forward for up to 5 years. Starting in tax years beginning after December 31st, 2025, C corporations may deduct charitable contributions only to the extent that they exceed 1% of taxable income, and that's calculated without regard to the contributions themselves. And then that existing 10% deduction cap does remain in place. So deductions are limited to contributions between that 1% floor and the 10% ceiling. And so contributions exceeding 10% can still be carried forward up to 5 years. So what this means is that companies may now need to consider aggregating those charitable contributions in select years to purposely exceed the floor and fully leverage their deductions. Next page, please. So here's a couple of examples. Let's say we have a taxpayer whose contribution base is $100,000, and that taxpayer makes a charitable contribution to a public charity of 70 grand in 2026. When we impose that 0.5% floor, that leaves 69.5 thousand deductible in 2026. However, when we apply the cap of 60%, only 60% could be deducted in 2026. Or sorry, 60,000 could be deducted in 2026. So the carryover, because both the cap and the floor have been exceeded, would be the remaining $10,000. So that full amount of $500 from the floor plus $9,500 beyond the cap can be carried forward for up to 5 years. However, if the taxpayer only made charitable contributions of 30,000, because the 60,000 cap wasn't reached, then the 500 from the imposition of the floor would not be deductible. It would not be able to be carried over. So that taxpayer is only going to be able to deduct 29,500 in 2026. So again, to carry over any amount, both the floor and the cap must be exceeded. And it functions the same way for a corporation. So one example here for the corp is, let's say a corp has taxable income of $500,000 in 2026, and they make charitable contributions totaling 65,000. Their floor would be that 1% of 5,000. So only contributions above that would be deductible. And then the max of 10%, which is 50,000, would be the max deductible. So the excess contribution of 15,000 in this example would be able to be carried forward for up to 5 years because both the floor and the max had been reached. Okay, we can go to the next slide, please. Okay, so before this new law related to casualty losses, really ever since the 2017 Tax Cuts and Jobs Act, individuals could only deduct personal casualty and theft losses if they were tied to a federally declared disaster. So for example, if you had a major storm damage, but FEMA didn't declare it a federal disaster, you receive no deduction. So now, under the OBBBA, this limitation is made permanent, and also with a significant expansion, which is losses from state declared disasters also now qualify. And this is a big deal for taxpayers in regions where states act quickly to declare emergencies, but perhaps federal approval comes late or not at all. So now when a disaster is declared a qualified disaster, that's a federally declared major disaster, taxpayers do not need to itemize in order to claim that loss deduction. It's an above the line deduction that's allowed. The 10% AGI limitation is waived. The $100 per casualty threshold gets bumped to $500 per casualty. And the taxpayer can take that loss in addition to the standard deduction. Next slide, and I believe I'm going to pass it on to my colleague, Mario. Oh, MAL, I think you're muted.
Oh, thank you. Is that better? Okay,
Yeah,
great. Thank you. Yeah, so the next provision that's brought to us by the OBBA is with respect to Qualified Opportunity Zone program. So first, the program gets an indefinite extension, and it's no longer sunsetting in 2026. Also, new Qualified Opportunity Zones can be designated every 10 years, and it keeps the program refreshed and targeted. Investors can now benefit from a rolling 5-year gain deferral, and there's a 10% basis step up at year 5. Previously, there was a 5% step up at the 7-year mark, so that's a change. Also, the eligibility for what constitutes a qualified opportunity zone becomes stricter with higher standards for zone designation. The new law also introduces qualified rural opportunity funds, which allow a rolling 30% basis step up after 5 years and reduces the substantial improvement threshold to 50% of adjusted basis, down from 100%. Long-term investors can now eliminate gains on post 10-year investments over a rolling 30-year period, with basis stepped up to fair market value on the 30th anniversary. And finally, the new legislation adds new reporting and penalty rules with respect to qualified opportunity zones. These changes are effective after December 31st, 2026. Next slide, please. So the new legislation also makes an important change to Section 707, which covers the treatment of payments from partnerships to partners for property or for services. The provision amends Section 707 to provide clarification that the law is self-executing in the absence of regulations. So previously, some practitioners have argued that because the statute defers to regulations prescribed by the Secretary and there are no regulations, that the statute is unenforceable. And so now the language in the statutory language brought to us by OBBA changes the language that said under regulations prescribed by the Secretary to except as provided by the Secretary. And so again, just as a reminder, Section 707 does two things. It recharacterizes income as ordinary income, situations where partners perform services to a partnership and there's a related allocation of partnership income or distribution to that partner. So an example of this would be like the management fee waivers, where a fund manager who's also a partner waives their rights to receive that management fee in exchange for a carried interest in the partnership, presumably at better rates than ordinary income if they'd received their management fees. In 2014, Treasury released proposed regulations, which were intended to provide guidance on when such fee arrangements or fee waivers would be treated as disguised payments for services, but they hadn't been finalized. And so, again, some practitioners had argued that these management fee waivers essentially were a good way to recharacterize income from ordinary income to capital gains treatment. And so the statute is clarified to make sure that it's self-executing. 707 also covers what we refer to in the partnership space as disguised sales. And those are situations where you have a transfer or contribution of property to a partnership, followed by a distribution or transfer of money to that contributing partner. The statute says when you look at those two, if you looked at those two together and they were in substance a sale, it recharacterizes it as a sale. This covers both disguised sales of property and disguised sales of partnership interests, which are also property. And we have extensive regulations under disguised sales of property, but we don't actually have regulations for disguised sales of partnership interests. So again, there have been those who have previously argued that, well, if we don't have statutes, if we don't have regulations for disguised sales of partnership interests, then we can't have a disguised sale of a partnership interest. And so again, this statute clarifies this is a self-executing statute. The IRS Treasury have for years made this point, so I think it really brings clarification to that. The changes to this law applies to services and transfers of property made on or after July 4th, 2025. Next slide, please. Another important provision by the new legislation is that the state and local tax or SALT deduction, the cap for that gets a significant lift. So for tax years from 2025 to 2029, the cap is raised to $40,000 for joint filers, which is and it increases 1% each year through 2029. However, there's a phase down to $10,000 for households that earn over $500,000 in modified adjusted gross income. So to the extent you exceed the 500,000 limitation, that excess is reduced by 30%. So here we have an example where husband and wife are married filing jointly. And in 2025, they have $550,000 of modified adjusted gross income, and they pay $40,000 in state taxes. So their SALT deduction, the cap is $40,000. It's reduced to $25,000, which is $40,000 minus 30% of the excess of $550 over $500. So essentially that phase out reduces their cap by $15,000. But what's important to note is that $10,000 is actually the floor. So in the next bullet, we see an example where that same couple, if they were to have modified adjusted gross income of $620, the SALT deduction wouldn't be reduced to zero. It would actually just be reduced to the $10,000 floor. And finally, the SALT deduction cap doesn't disturb the PTET deduction, which is a pretty improved provision over the House version, which pulled in PTET for especially for SSTBs and provides, and it included co-op taxes under Section 216 as subject to the cap. So that's no longer included in this SALT deduction cap. Next slide, please. And we finally have some good news for residential developers. Under the percentage of completion method under Section 460, the new legislation provides that all long-term residential construction contracts are exempt from the using the percentage of completion method. So it's just important to note that previously only home construction contracts were exempt from that requirement. And additionally, residential construction contracts, which are not home construction contracts, are exempt from the 263 Cap A capitalization requirements if the contract is estimated to be completed within 3 years. The taxpayer meets the 448 gross receipts test for the year in which the contract is entered into. This applies only to contracts beginning after July 4th, 2025, and it especially benefits builders and developers of condominiums and other multifamily complexes. And so that's all the changes for under federal. I will then turn it over to my colleague Bob, which will cover the credits and incentive provisions.
Thanks, Mario. Next slide, please. And the next one. So I'm going to discuss the new section 174A, which relates to the current deductibility of domestic R&D expenses. But before I do that, I just want to level set in terms of the old section 174, which required domestic R&D expenses to be capitalized and amortized over 5 years, and foreign R&D expenses to be capitalized and amortized over 15 years. And this requirement for the capitalization became effective in 2022. So under the new section 174A, which is now permanent, domestic R&D costs are now currently deductible. So all taxpayers can currently deduct domestic R&D expenses for tax years beginning after December 31st, 2024. Foreign R&D expenses continue to need to be amortized, capitalized and amortized over 15 years. So there is a large discrepancy between the current deductibility of domestic R&D expenses versus the 15-year capitalization amortization requirement for foreign R&D expenses. All taxpayers can elect to deduct previously capitalized domestic R&D expenses. So, for example, if you had capitalized domestic R&D expenses in, let's say, 2022, in 2023, in 2024, let's assume you filed your 2024 return, in 2025, whatever that unamortized balance is of those domestic previously capitalized costs can be expensed currently in 2025 or ratably over 2025 and 2026. So keep in mind that applies to all taxpayers. It is an election, and it also requires a change in method of accounting. There is a special section in 174A related to eligible small businesses. So an eligible small business is a taxpayer that has average gross receipts of $31 million or less from 2022 through 2024. If you're an eligible small business, you are able to retroactively apply the new Section 174A rules back to 2022. Basically, if you previously capitalized domestic R&D costs in 2022 through 2024, you can now go back and expense those costs. It is an election and a change in method of accounting, and it does require the tax returns to be amended. There's also another interesting note related to Section 280C elections, which deals with the R&D tax credit. And many taxpayers, when the capitalization came about under the old Section 174, went from claiming the reduced R&D credit to the full R&D credit. The IRS is now allowing taxpayers to revoke that full credit election and instead make the reduced credit election in those years that are being amended. So that's something that that should be analyzed as part of the process if you are thinking about going back and amending. There are some other elections that are available under 174A. In some instances, depending on a taxpayer's fact pattern, they may want to continue to capitalize and amortize costs. And they can do that. There's an election available to capitalize and amortize over 60 months, with the amortization beginning in the when the taxpayer first realizes the benefits of the research. And there's also Section 59E, which allows 10-year amortization of domestic R&D expenses. There are still a lot of questions to be resolved related to the new Section 174A. We anticipate that the government will be coming out with some guidance, to be determined when that guidance will come. But there are questions related to items such as the elections, the changes in method of accounting, the amended returns, as well as some other technical issues. So hopefully that guidance will come out and provide some answers. I'm going to hand it over to Sean Sottle, who is in our federal C&I practice, and he's going to discuss some energy credits.
Great. Okay, let's move on to the next slide, please. Okay, and it's time to put on your seatbelt, everybody. I know that I talk quickly, but I also have a lot of ground to cover, so let's go. In addition to helping our clients with the research and development projects that Bob discussed, the Credits and Incentives team has also been fielding plenty of questions regarding the energy tax credits that were enacted by the Inflation Reduction Act. A more detailed account of the changes that were made to the energy credits is included in the Citrin ebook. I included a link on the slide there. I simply don't have time to dive into all of the details in this presentation, but the legislation essentially takes a chainsaw to any provision of the tax code related to clean energy or climate change. This includes tax code provisions like 179D regarding energy efficient commercial buildings, and that was first enacted way back in 2005. Now, I'm going to discuss 45Y and 48E in more detail in a second, but the remainder of the energy tax credits were amended most commonly by changing the termination date of the individual credits. In some cases, the credits were effectively terminated the date the bill was signed into law. Yes, back on July 4th. Many other credits will be ending at the end of this year, so in a few months. These credits were nuanced and technical from the outset. With the new changes in place, if any of you are trying to claim one of these credits, we are under the gun here. Assuming the specific credit pertaining to your project still exists, we likely have just over 5 months to ensure each of the statutory and regulatory criteria are met to claim the credit. And the language in the statute specifically requires that the projects be, quote, placed in service. That means plugged in, on the grid, operational, and done by the termination date of the credit. So if you're listening to me now and thinking that this all sounds like a tall order, you're right. Congress made a policy decision to claw back some of the funds allocated to these energy credits to pay for some of the other provisions that we've all been discussing earlier today and that we will be discussing after I'm done. But my point is that making it difficult to claim some of these credits from here on out is part of the design, part of the congressional intent, but we can adjust to that. Now, I mentioned I'd like to take a moment and spend a little more time on 45Y and 48E. These were two of the most significant credits passed by the Inflation Reduction Act. Both credits are technology neutral and provide a credit for the production of electricity from a renewable energy source. The 45Y credit calculates the credit amount based on the actual amount of energy created, and the credit can be claimed annually for 10 years, or at least it could, whereas the 48E credit can be claimed once and is a percentage of the costs incurred to install the energy production facility. As originally enacted, both credits included a graduated phase-out period that reduced the amount of the credit over a period of years. But the new legislation has now accelerated that phase-out period. For example, with respect to wind or solar facilities, the credit is effectively eliminated after 2027. For the 45Y and 48E credits in particular, taxpayers have the opportunity to begin construction on the energy products, even if it's placed in service at a later date. Now, beginning construction is a term of art in the energy credit space, And satisfying the definition of beginning construction is spelled out in a series of IRS notices that predate the IRA. Most importantly, there's a taxpayer-friendly 5% safe harbor, meaning that once the taxpayers incur 5% of the overall cost of the project, it formally begun construction. This date locks in the date on which the credit is calculated, even if a later phase-out period begins while construction continues. But on July 7th, President Trump signed an executive order, and I want to get the language of this executive order verbatim. He directed the Treasury Department to enforce the beginning construction policies by preventing the artificial acceleration or manipulation of eligibility and by restricting the use of broad safe harbors unless a substantial portion of a subject facility has been built. So I described the 5% safe harbor, which applies if 5% of the overall costs of the project have been incurred. But this standard was set forth in the IRS notices, which do not have the force of law. Now we see the administration setting forth a new standard regarding a substantial portion of the facility. And again, this is consistent with the credits becoming more difficult to claim. Now there's additional broad, vague language regarding prohibited foreign entities. A strict reading of this language indicates that if, for example, a Chinese solar panel manufacturer is declared a prohibited foreign entity, then installation of these solar panels would disqualify a project from a credit under 45Y or 48E altogether. While the new legislation has created new compliance headaches for the energy credits, I'm not discouraging anyone from applying for the credits. My only point here is that we must ensure we document every qualification, dot every I, and cross every T. So please be in touch with your direct Citrin contact to get our team involved early so we can help assess what rules apply to your project and whether the credit is still available. So I'm going to stop there and hand the mic over to Fred Corso to discuss the international tax issues. Thanks, everybody.
Thank you, Sean. If we'd skip ahead just to the first slide. There are a number of provisions that we could speak about and that are included on these slides, but there are a handful that I really want to focus on. So I'll touch upon a few along the way here with the intent of giving my time to the few topics that I think are, again, of most importance. Just as a little bit of context for the changes that we want to focus on, I just want to remind everyone that specifically in the context of the United States international tax paradigm, the TCJA was really a sea change moment. It shifted us from a general system of deferral to which certain anti-deferral rules applied in certain limited contexts over to something that's more like a quasi-participation exemption regime. So in connection with that change, there were two new concepts that were introduced. One of them is the Global Intangible Low Taxed Income, or GILTI regime, and the other was the Foreign Derived Intangible Income regime. They're sort of the carrot, or the stick and the carrot, so to speak, where the former seeks to impose some type of a minimum tax on the income of foreign operations of a multinational business, while the latter is intended to provide an incentive for investment and the carrying on of activities from within the United States. So we'll get to those rules afterward, but those are the rules that have important changes to them in my mind. So just to call out a few of the changes that are of relevance in other contexts, a particular rule called the CFC, or Controlled Foreign Corporation Look-Through Rule, which had historically been extended time and time again as there were different items of tax legislation along the way. This rule, which is very important, was made permanent. So that's just a nice to have and creates some predictability for the future. There is also a rule that has historically allowed U.S. shareholders of controlled foreign corporations to treat their U.S. tax years of those controlled foreign corporations as starting 1 month in advance of their own year. And this effectively allows or has allowed certain U.S. taxpayers that elected for this deferral to defer for 11 months the inclusion of income from their controlled foreign corporations. But that rule has been repealed, and now there's a requirement for conformity with the U.S. shareholder year. So if you are a calendar year U.S. shareholder of a controlled foreign corporation, your controlled foreign corporations will have to migrate to a conforming calendar year as well. There is a new set of rules called the pro rata share rules, which fundamentally seek to address certain complexities that arise when one U.S. shareholder of a controlled foreign corporation sells its interest in that controlled foreign corporation to another person. Without going into great depth, the deemed income inclusions of the seller and the buyer are determined with reference to the U.S. shareholder who owns the controlled foreign corporation at the end of that controlled foreign corporation's tax year. Again, complex rules, but what this change of rules seeks to do is to make it so that anyone who is a U.S. shareholder in a controlled foreign corporation at any point in the year will include their pro rata share of the earnings and profits of that entity, as it may be, however it may be characterized, based on that ownership period, and not necessarily with reference to numbers that are determined at the end of the year in the hands of the then current U.S. shareholder. And this was, I think, predominantly changed in order to address certain planning abuses that were perceived. Next slide, please. One bullet point on this one. I'm not going to go into any depth on the BEAT tax, but it's starting after December 31st, 2025, the applicable rate, which is a 10% rate, will be increased to 10.5%, and it has been made permanent. So for those taxpayers that are subject to BEAT, this will be an ongoing matter or item for them to monitor with a potentially a slightly higher tax rate. Next slide, please. Okay, so a lot of words on this slide. We're going to address foreign tax credit matters first, and I really just want to draw people's attention to the small formula that's on the left-hand side. The foreign tax credit operates to offset U.S. tax on foreign source income, and that is essentially, in simplistic terms, determined using a very basic algebraic formula. The foreign tax credit limitation, which is the maximum amount of tax that a U.S. shareholder can offset with foreign tax credits, or a U.S. taxpayer can offset with foreign tax credits, is equal to that person's foreign tax times the foreign source income of that taxpayer over the total taxable income of that taxpayer. Simple formula, everything to get to the numbers in that formula, that's where the work is. But more specifically, foreign taxes have to be associated with a particular type of income. So you might have general income or passive income, subpart F income, or critically here, GILTI income. So I described or mentioned what GILTI is before. GILTI is an anti-deferral provision that was introduced in 2017. And when a U.S. taxpayer has an item of GILTI income inclusion, if that person is either a domestic corporation or an individual that makes a Section 962 election, that person can avail themselves of a foreign tax credit for, potentially so, for the foreign taxes that are actually paid by the controlled foreign corporation itself in the local jurisdiction in which it is organized or operates. That foreign tax credit is limited based upon how the domestic shareholders' expenses are allocated against that gross income. So the foreign tax credit limitation is critical because you may have a substantial amount of foreign tax that would be creditable. You may have a substantial U.S. tax liability, but if based on the hard work, it's determined that substantial expenses must be allocated against the foreign source income, it can drive that foreign tax credit limitation down and potentially eliminate it altogether. So this change and others seek to make that a less punitive outcome for shareholders that have GILTI income inclusions. And that is achieved through a number of different things, including, most importantly, preventing the allocation of interest expense and research and experimental expenditures against GILTI income. That's a very big change, a very important change, because it has the potential to increase the foreign tax credit that is available to U.S. shareholders, and then some other limited allocations as well. Can we go to the next slide, please? In addition to that, there's the question of how much of the foreign tax is actually eligible for a credit. And under current law, that foreign tax that is paid by the foreign corporation is haircut by 20%. So therefore, only 80% of that foreign tax can be taken into account. That 20% haircut is being reduced to a 10% haircut. Therefore, 90% of the foreign tax would be potentially available as a credit. There are some other changes that I won't bother discussing regarding distributions of what's called previously taxed earnings and profits. I'd really rather focus on the fact that thus far the changes in the rules seek to create more capacity for U.S. taxpayers to take more of a foreign tax credit against their foreign source income. Next slide, please. There is also the question of source. Again, if you refer back to that algebraic formula, it's the calculation is determined using foreign source income over total taxable income. So sourcing is critical. And when the TCJA was enacted, there was a change to a prior provision that essentially it did cause domestically produced inventory and the sales revenue associated therewith to be sourced as domestic source income, not foreign source income, despite the fact that the sales may have been made to foreign persons. And that ended up having a strong suppressive effect on taxpayers' ability to take foreign tax credits associated with those sales, where those sales might be carried out through foreign offices that they own directly or through foreign disregarded entities that have offices with which the U.S. owners transact. And this change seeks to get back to something that was like the prior rule, such that if that foreign office is a material factor in the sale of the U.S. produced inventory to a foreign customer, then up to 50% of the income on that sale can now have foreign source. Again, this has the effect of potentially increasing the taxpayer's foreign tax credit limitation. Next slide, please. Okay, the stick and the carrot, GILTI and FDII. When these concepts were introduced, they had somewhat of an unintended effect of, on the one hand, in the case of GILTI, actually incentivizing businesses to move operations and activities offshore into controlled foreign corporations. And that is generally because the effective rate, because of the operation of different rules on that income, was around 10.5%. Could be a little bit higher, could be a little bit lower. But it was generally much lower than the 21% that would be applicable to a domestic corporation. Meanwhile, the carrot, FDII, which provides for a 37.5% deduction against eligible income, resulted in a tax rate that was more like 13.125% or perhaps higher, depending on the circumstances. So although it was supposed to be carrot or stick and carrot, it didn't quite have the intended outcome. And that this is in particular the result of two things. Number one, a statutory deduction that is made available with respect to each. GILTI is eligible, or GILTI income is eligible for a 50% deduction, and FDII is eligible for a 37.5% deduction. So there's a big gap. But also there is this concept, and the DTIR and NDTIR, or what's called the deemed tangible income return, with respect to each, and that represents a floor. And in the case of GILTI, that floor, which is 10% amount, so 10% times qualified business asset investment, that represents a floor that will not be subject to current taxation, and therefore is excludable from taxation. So if you were are a high capital intensive foreign business, it behooves you, or has behooved you, to have large capital outside the United States, because you could generate foreign income and exclude a significant portion to that, or of that. In contrast, when you think from a policy perspective that the FDII regime is intended to encourage U.S. investment in business infrastructure, it actually has the opposite effect. That floor is what's calculated, and then only the amount above that floor is actually eligible for the deduction. So it does not have the incentivizing effect that might have been intended. So the changes to the rules prospectively are made through a couple of different changes. First, The statutory rate for the deduction for guilty is reduced to 40%, and the statutory rate for the deduction for FDII is reduced to 33.34%, let's just call it a third, which are reductions to rates that are actually smaller than what were originally expected to occur in 2026 if no change to law had occurred. But I think even more importantly, that concept of the net tangible income return is eliminated in both contexts. So therefore, that floor that would help exclude foreign source income before is eliminated, and therefore the base for guilty inclusions would be expected to increase. Meanwhile, that floor for the FDII deduction is excluded. It will not exist. Therefore, the base for that deduction, a domestic deduction, increases, particularly for businesses that, again, are intensively or engaged in intensive capital industries. So these are clearly changes that are intended to achieve policy outcomes. I think that they are welcome changes for many, although if you have CFCs that are engaged in significant businesses outside the United States and are capital intensive, perhaps that's not as beneficial to you. However, keep in mind that there's a balancing act that happens. The base for the foreign source income may have increased, but the potential to take larger foreign tax credits against the tax on that income has also increased. So from a scoring perspective, I think that those changes were intended to be somewhat neutral. And then with FDII, as with guilty, the allocation of research and expenditure, research expenditures and interest expense are also not allocated against deduction eligible income. So that too is very taxpayer friendly. So again, a sea change in 2017, and now that we're in 2025, these changes represent refinements and enhancements that achieve policy goals, but help to also correct for other problems that were considered to have arisen in the last 8 years or so. Next slide, please. We can actually skip over this because I've just discussed this in the prior slides. Next slide, please. And then this I'm just going to touch on very, very briefly. The prohibition against something called downward attribution, which is a section 958B4, which was repealed in the 2017 Act, has been reinstated or prospectively. And that section was repealed at the time, most notably for the purpose of trying to address a slew of inversion transactions that were occurring, but there were very significant unintended consequences that arose by creating what we refer to as constructive controlled foreign corporations. And the ripple effects of that change was just enormous. And there was never a technical corrections act that allowed for it to be somehow refined. Well, this particular change represents a refinement. That section has been reinstated so that many of the problems that arose in the past will cease to be problematic in the future. But concomitantly, a new section 951 Cap B was introduced, which addresses a concept of the foreign controlled U.S. shareholder. And I won't go into much depth here. I will simply say that this, in my mind, is intended to more narrowly go after the structures that resulted from prior tax planning, and that the original change in 2017 was sought to address, but this now does it in a much more narrow and targeted manner without all of the other correlative effects that resulted from the original change. With that, I will turn it over to Dan for trusts and estates topics.
Thanks, Fred. Next slide, please. All right. So our transfer tax system is comprised of 3 separate elements. The federal gift tax, which is a tax imposed on taxable gifts made during the year. The estate tax, which applies to transfers of property at death. And the generation skipping transfer tax, which is imposed on transfers that benefit individuals who are more than 1 generation below that of the transferor, like a gift from a grandparent to a grandchild. Through these 3 components, our system potentially taxes up to 40% of a person's accumulated wealth. There is one silver lining in that taxes are owed only to the extent that the amounts transferred exceed the exemption amount, which is also known as the basic exclusion amount. Under prior law, we were in a very unique period of time. The TCJA doubled the basic exclusion amount for years 2018 through 2025. That amount went from 5 million to 10 million, and the figure was adjusted annually for inflation. This provided us with a basic exclusion amount of almost 14 million. It was at 13.99 million this year in 2025. However, the increase was only temporary, and without any changes, the basic exclusion amount would have reverted to its pre-2018 level of $5 million adjusted for inflation when we move into 2026. Most practitioners thought this number would have landed somewhere right around $7 million. And it's because of this scheduled reduction in the exemption amount that ultimately less wealth would have passed tax-free to heirs. By way of example here, and again, this would be under prior law if the sunset had occurred, we have Gary, a single individual who dies in 2026 with a taxable estate of $20 million. Here, his estate would have generated an estate tax due of approximately $5.2 million. This is because the exemption amount dropped from 14 million in 2025, or almost 14 million, to a little over 7 million in 2026. So to plan for this sunset, a lot of individuals had done things like accelerated gifting because certain gifts made before 26 could lock in that larger exemption amount. That was then in effect. Next slide, please. So let's take a look at what changed under the new law. For tax years beginning after December 31st, 2025, the estate and gift tax basic exclusion amount has been permanently increased to $15 million. Starting in 27, that amount will be indexed for inflation. The GST exemption amount is based on the basic exclusion amount, and so it also has increased to $15 million. And again, this would apply to scenarios where a decedent dies or makes gifts or generation skipping transfers starting in 2026. The new basic exclusion amount is not subject to any automatic reversion or sunset, so it does provide a bit more permanency for planning purposes, at least for now. Individuals who have already utilized all their available exemption now have a little bit more, over $1 million more in exemption to start using in 2026. And if we refer to our example again, we can see how it affects Gary under the new law. He still has a $20 million estate, but the exemption amount has increased to $15 million. So if you recall under prior law, and if that sunset had occurred, the exemption would have reduced to approximately $7 million, leaving Gary's estate with a $5 million tax bill. And as we can see here now, his estate will only pay $2 million under the new law. Obviously, this is a better benefit. It results in significantly more wealth passing tax-free to Gary's heirs. Notably, the bill did not affect the annual gift tax exclusion amount, which still remains at $19,000 for 2025. Portability, or the ability of a surviving spouse to use a deceased spouse's unused exemption amount, also remains intact. However, even with the increase in exemption, we think it's important to keep thinking proactively about estate planning. It still remains critical due to the impact of things like state estate taxes, which often have much lower thresholds and no portability. So in this case, strategic gifting can reduce exposure to these state level taxes. Gifting in general is always important because it allows an individual to remove that future income and appreciation out of their taxable estates. Next slide, please. So I have one final slide, and I'll try to keep it moving here. There are some changes to tax advantage savings vehicles under the new law. Qualified tuition program, which is commonly referred to as a 529 plan or a QTP, have two big benefits. The earnings accumulate tax-free, and then the distributions are excluded from income if they're used to pay for what's called qualified education expenses. Starting in or after July 4th, 2025, the definition for these expenses has been expanded. for students who attend private or public K through 12 pass tuition to include things like books, online education materials, tuition for tutoring. In addition to the expanded definition, it also increases the annual limitation for these types of expenses from 10,000 to 20,000. And finally, they included a new subcategory called qualified post-secondary credentialing expenses, which means that you can use 529 funds for tuition or supplies in certificate programs, even if they're not traditional degree programs. And on the right side of the page here, there is a totally new type of tax advantage savings account called a Trump account. It's treated like an individual retirement account, can be open for beneficiaries who are US citizens under the age of 18 and who have a valid Social Security number. There's a lot of nuances currently with contributions, taxation, but generally the contributions will be not tax deductible and limited to $5,000 per year for what they call non-exempt contributions. Employers can contribute up to $2,500 per year for the benefit of an employee or their child. And for children born from 2025 to 2028, the US government will actually contribute as part of a pilot program an initial $1,000 to that account. While contributions are not tax deductible, the earnings grow tax-free until they're distributed from the account, but generally no distributions or withdrawals are allowed until that beneficiary attains age 18. The one thing to keep in mind here is that when those amounts do come out of the account, a portion of each distribution will be a non-taxable return of basis, with the remainder taxed as ordinary income. And so I think to wrap up here, while these Trump accounts may complement tools like 529 plans, custodial accounts, or other tax advantage savings vehicles, I think everyone needs to weigh the benefits of things like early compounding and tax-free buildup against some of the potential risks of adverse tax treatment or loss of flexibility within their broader estate financial planning and educational planning strategy. And with that, I will hand the presentation over to Jenny.
Thanks, Dan. OBBBA did not have a lot of provisions in it that impact procedure or controversy, but there were a couple of important pieces that did make its way in. Next slide, please. Probably one of the more impactful changes is the change to the reporting for third-party settlement organizations like PayPal, Venmo, eBay, etc. For those before the OBBBA, these entities had to report file 1099-Ks for if the transactions for a particular payee exceeded $600 for the calendar year. So that's a fairly low threshold, and these many people were getting these 1099-Ks when they used PayPal, Venmo, etc. to exchange money, either through usually as selling knickknacks or the like. And this was also the threshold for any backup withholding that was required with respect to the payee. Starting in 2025, this rule has been changed such that these organizations are only required to file 1099-Ks for a payee if the transactions for a calendar year exceeded $20,000 and the aggregate number of transactions for the year exceeded $200. I mean, 200. Not 200 transactions, not dollars. This same threshold would also apply for backup withholding. So this change is going to result in significantly fewer 1099-Ks being issued to payees that utilize these types of payment vendors to get payments for various gig economy and small sales. Next slide, please. The other changes that were made were with respect to the Employee Retention Tax Credit, or ERTC. I'm sure a lot of people on here are familiar with this. This was a COVID era credit that allowed credits against payroll taxes, which could be refunded if businesses kept people employed during COVID. With certain criteria were met. As you may have heard in the news over the years, these claims, there were a lot of fraudulent claims paid to people, and a lot of fraudulent claims made by people for the ERTC, which resulted in a humongous backlog and everything at the IRS dealing with these fraudulent claims. So, a few changes were made to kind of address this issue. The biggest, one of the first changes is that the IRS cannot issue any ERTC refunds if the claim was not filed before February 1st, 2024, which was well over a year ago at this point. So no new ERTC claims. It also created a new penalty for what they refer to as COVID ERTC promoters who failed to comply with the due diligence requirements. Whether or not somebody is a COVID ERTC promoter is based largely on what percentage of their income comes from these filing these claims, aiding, assisting, providing advice with respect to these claims. It's given that you cannot file any new ERTC claims, and these provisions are not effective, and except for after the date of enactment, which was July 4th, 2025. This penalty, I guess, is only really going to apply to new actions on existing claims by those who would meet the definition of COVID ERTC promoters. Next slide, please. The provisions that will have the most impactful effect on those of you on the phone will be the fact that the OBBBA extended the period of limitations for IRS to go after these ERTC claims if they were improper. So the IRS has 6 years from the date of the original return for the period or the date that the ERTC claim was made to assess any tax attributable to that ERTC claim. So if it paid out a ERTC claim and it was later on determined to be incorrect, the IRS would have 6 years instead of the normal 3 years to go after that incorrect ERTC. But on the flip side, it also extends the time frame for which a taxpayer can file a claim for refund attributable to the disallowed wage expense for ERTC. So if a taxpayer claimed an ERTC with respect to $100 of its wages, it could not then also deduct that $100 worth of wages on its income tax return. People were generally supposed to amend the returns if they had already filed. This didn't really happen. But and recently, earlier this year, the IRS issued new guidance on this situation, which allows taxpayers to include the amount of the ERTC in income in the year it was received, and if they did not reduce their wage expenses in the origin year, instead of going back and amending those prior years, many of which are now closed. Likewise, if they taxpayer did reduce its wage expenses and the claim was ultimately denied, the taxpayer could take the deduction in the year of the denial. And that's based on a FAQ issued by the IRS in March of this year. So, the OBBBA extends the time for them to file a refund claim if they did reduce their wage expenses in the origin year, i.e. to file an amended return to take those wage expenses again. So you can, I guess, do either. You can you can either take the deduction in the current year or go back and amend to increase your wage expenses if they were previously reduced due to a subsequently denied ERTC claim. And there, it also amends the one of the penalties to include ERTC claims. Therefore, there is now a 20% penalty if there is a for the amount of a claimed refund over the actual refund allowed, provided that there is a not reasonable cause for the difference there. So there are a few changes that were made. Not the 1099-K changes will primarily affect those larger third-party settlement agencies like PayPal and Venmo and the like. And then there were some changes made to some of the enforcement provisions of the ERTC, but largely this bill does not address many enforcement or controversy matters this time. So I am now going to turn it over to Jamie to talk about SALT.
Thank you, Jenny. I'm going to be talking about some issues related to SALT. And I always kind of laugh when I hear the acronym SALT, because I think pre-Tax Cuts and Jobs Act at the end of 2017, a lot of people didn't really know what that acronym means, even though in my world, that's sort of the everyday of what I do. So now I think everyone is very intimately familiar with SALT and what it means and sort of what the implications are going forward. Can we jump to the next slide, please? So when we think about state income taxes, right, and specifically personal income taxes, and why is that relevant, right? 40 states impose personal income taxes. It's probably the most ubiquitous type of state tax. And most businesses, as we know, are organized as pass-through entities. So as a result, the tax is paid right at the individual level, the personal level. And when it comes to personal income taxes across the states, with the exception of pretty much two, the state tax base usually begins with federal adjusted gross income, right? So they take the federal adjusted gross income, and then there's a host of modifications, whether certain additions, subtractions, that the state makes to modify the tax base in terms of whether or not they're going to adopt certain federal provisions or decouple from certain federal provisions. So one of the things that comes up all the time whenever we have federal tax legislation and we're thinking about personal income tax is, what's the conformity status, right? Does the state have what's called rolling conformity, meaning that whenever the Internal Revenue Code is adopted, the state goes ahead and adopts all those changes automatically without any subsequent legislation, regulation, or guidance? Or there's also what we call static conformity, right? Which states that have adopted a version of the Internal Revenue Code, but maybe that Internal Revenue Code is fixed at a specific year, not adopting the most recent provisions. So that's kind of the key analysis that comes into play when we're looking at these federal tax changes from a personal income tax perspective, is what is the state's conformity statute? And here on the slide, as you can see, I listed out some examples of rolling conformity in New York, like in Oklahoma, DC, Delaware, right? That they're going to adopt the code as is, as it gets modified by the federal government, by Congress. And then static conformity states, examples like Arizona, California, that adopt, again, specific versions of the Internal Revenue Code, and therefore are going to require, modifications, adoption, subsequent legislation to deal with the federal tax changes. And then, I just mentioned, again, two exceptions. New Jersey and Pennsylvania are states that have personal income taxes, but they are imposed on separate buckets of specified classes of income, and they don't adopt generally these federal provisions. Next slide, please. And so the next area that we're going to be talking about, right, is corporate income tax, right? So out of all the states, roughly 44 states impose corporate income taxes on C corporations, right, that are conducting business in the state. And when we think about the starting point for corporations, typically it starts with line 28 taxable income on the 1120, right? So taxable income before NOL, before net operating loss and special deductions, although some states use taxable income on line 30. So again, we're left with the analysis / question of, since we're using, right, the federal number from the return, whether it's line 28 or line 30, to begin the computation of the state corporate income tax base, what is the status of the conformity statute in the state, right? Do we have rolling conformity like a New Jersey, a New York, a Tennessee, Virginia? Or are we a static conformity state, again, like we mentioned, a California, a Texas for franchise tax are very prominent examples, again, of jurisdictions that have frozen their codes and have adopted previous versions, and now will have to either choose to adopt federal provisions or maybe modify certain ones if they want to adopt their codes going forward. An important point, though, is despite all this conformity discussion and the statutes that are involved, in general, most jurisdictions have already decoupled from bonus depreciation provisions. And the way that they've done so is typically they've adopted a version of bonus depreciation that goes back to a prior year, whether in 2005, early 2000s, even before. There's prior, again, bonus depreciation provisions that have been adopted and that have kind of frozen the state rules. Next slide, please. So one of the hot areas that has come up, and again, we talk about the SALT acronym, right? State and local taxes, is the elective pass-through entity tax regime at the state level. So a little background on what that is. As we talked about, right, under the TCJA earlier, the SALT cap, right, the cap on an individual's deduction was $10,000, currently is $10,000, right, under the TCJA. And as a result of that, a lot of states, we're now up to more than 36, have adopted what's called these elective pass-through entity taxes. And really what that means is the pass-through entity, right, S corporation, a partnership, makes an election to pay tax at the state level, at the entity level, instead of passing through the items of income to the individual owners and shareholders. The result of that, right, is because the SALT cap is imposed at the individual level, there's no limitation currently on the entities level to deduct state taxes, these elective state taxes, for federal income tax purposes. There is no limitation, again, because that SALT cap applies at the individual level. And in late 2020, the IRS issued Notice 2020-75, which essentially blessed these concepts of pass-through entity taxes and didn't really put much limitations or guidance. And so they've been, strategies that have been employed, again, in most jurisdictions that have personal income tax codes. As mentioned earlier, these pass-through entity taxes, there was no limitation, there were no changes made under the federal tax law. There was discussion of limiting for various certain professions not being able to use these regimes. But, thankfully, like as we talked about, the federal tax law did not make any changes. So these are still viable planning tools for pass-through entity owners and are highly recommended. There is some discussion, however, we are hearing whispers that maybe IRS Notice 2020-75 can be modified a bit to tighten up this regime a little bit, provide a little bit more guidance, a little bit more limitations on sort of what types of entities can make the election and how those deductions can be taken. And then the final piece sort of that needs to be talked about in terms of the PTE current regime, the pass-through entity taxes, is that certain jurisdictions kind of made their elections based on there being a SALT cap, or some made their elections based on there being the $10,000 limitation, or some tied it to a specific year. So you're seeing state codes being amended to now extend those PTE taxes going to beyond 2026. So that, again, keeping in play with federal, that these are now mechanisms that are going to be in the law, as long as the SALT cap is in place. Next slide, please. So one, and maybe two actually potential changes that we could see, though, right? We said that these elective pass-through entity taxes are remaining, but what are two potential changes we could see? Maybe one is when the entity makes the election, allowing individual owners to opt in and out, like California does currently. Another potential change we can see is that when the entity elects in, they actually the individual owners get a credit on their individual returns to basically wipe out the individual tax. We can see that maybe there's going to be a haircut to that credit, maybe only getting 88%, 90%, 92%. Connecticut and Massachusetts already do that, so we can see more states adopting similar policies. Next slide, please. So we're going to be talking about next, Fred mentioned the net CFC tested income and all the foreign aspects of that. And the one thing that I'll just point out, or two items that I'll point out are, with the broadening of that base that Fred talked about, plus the reduced 250 deduction, and at the state level, there's no foreign tax credit usually. there's going to be the opportunity for states to capture, what we used to call GILTI, this new net CFC tested income. And we're already seeing states that have made changes. Most recently, about a month or two ago, Illinois changed their dividends received deduction policy for GILTI and likely what will be net CFC tested income to only cover 50%. And Minnesota made a similar change as well a year ago. So you're going to see states potentially going after the tax base by eliminating potential dividends received deductions, not treating this income like a dividend, therefore not getting an exclusion. We're also seeing that there's going to be changes maybe to the apportionment factor. And the apportionment factor is merely just the way that the company calculates how much of its net income is subject to tax in the state by various formulas. We're seeing that GILTI, used to be excluded from a lot of those formulas, but now there's talk of either including or putting various laws in place that are going to capture the GILTI income by inclusion in the tax base and by apportioning it by the company's regular apportionment factor. So those are things that we're watching, that we see, that we think they're going to be revenue opportunities for states to grab. Next slide. Next quick item we're going to be talking about is, Bob talked about Internal Revenue Code 174 and immediate expensing. There's just two quick things that we want to mention. Is just one, some states decoupled from the federal regime already. So it's going to require sort of looking at the individual states and seeing whether or not they decoupled from the 2017 version already. Those states include like Georgia, Indiana, Tennessee, New Jersey. The next item is, when thinking about amending returns to take the full expensing, there needs to be some thought at the state level given to whether or not tax credits were utilized. Maybe it has an impact on state net operating losses, as well as the apportionment factor can drastically change from year to year. So these are just sort of added complexities that need to be thought about when thinking through amending returns for the immediate expensing. And then next slide, please. Final point that we're going to touch about is Public Law 86-272. This is a statute that was passed several decades ago that basically protects companies from being subject to a state income tax if their only activity is selling tangible personal property into the state. And there was talk of modifying 86-272 as part of this legislation to allow for more protected activities and allow companies to conduct more activities without losing this exemption. But unfortunately, that language did not make it into the final bill, but there is discussions of it being revisited. So that's something that we're watching as well and paying careful attention to. And thanks for your time on the SALT slide. And now I'm going to turn it over to Amanda Adams.
Thanks, Jamie. So probably the most relevant information for NFPs is, in fact, what did not make it into the final bill. That is, first, there was a proposal to revive the tax on nonprofits that provide parking to their employees. That was enacted in the past, and then it was reversed. So fortunately, that did not make it into the final bill. Second, there was also a proposal on having a tiered excise tax rate for private foundations in lieu of the flat 1.4% tax on investment income. There was a proposal to have higher tax rates for foundations based on their asset size. Fortunately, that did not make it into the final bill as well. Next slide, please. So while there are just a few colleges and universities that have endowments of such a size that they're subject to the tax on net investment income based on their endowment size. Again, here we did have a tiered tax rate proposal that made it into the final bill, which means for these few institutions, which I believe some have put estimates as 30 institutions or less, now those institutions will have to pay a tax rate based on their per student endowment. This applies to tax years beginning after December 31st, 2025. The change to the definition of applicable institutions also apparently reduced the number of institutions that this applies to. So that is very important for those organizations. Some may have a higher tax bill, some may have a zero or much reduced tax bill thanks to these provisions. Next slide, please. For those organizations that pay executive compensation in excess of $1 million or an excess parachute payment, those institutions will need to expand the definition of potential employees that are covered under this tax. So while it may be easier for them to determine which employees they need to consider for purposes of determining this tax, there may be more employees that are covered. So there may see a higher tax bill as a result of this. This also applies to tax years beginning after December 31st, 2025. Next slide, please. The last item we wanted to bring to your attention today is that there is a new potential tax credit for contributions made to scholarship granting organizations. So these are 501c3 organizations that make scholarships for elementary and secondary educational expenses. And so for individuals that contribute to these organizations, they may have a greater benefit to their tax situation because they can claim a tax credit for those contributions instead of a contribution deduction. So we'll see how this all plays out. States will need to opt in to be able to provide this credit at a federal level. So hopefully things will be implemented. This all applies to tax years beginning after December 31st, 2026. So there will be some time for implementation. Brian, can you please wrap up?
Sure, appreciate it. Thanks, Amanda, for the speed run, getting us out as close to on time as possible. I want to thank everyone for attending today. All of the materials, the presentation was recorded today, but all of our OBBA materials are found on our website. You can go and see a dedicated page. We continue to publish thought leadership, and we'd really encourage you to reach out to your advisors, continue the conversation that we started today, and we look forward to talking to you more about how this affects you as an individual or your business. Appreciate everyone attending today. Thank you so much.